Hello everyone and welcome to our revision. My name is Mr. J.M. Kimani, your lecturer in Advanced Management Accounting. Welcome to continuation of the revision of this paper, November 2018. This is question 4 we are revising. Question 4 was testing on performance evaluation, the balance scorecards, as well as the life cycle costing, which this still is on pricing decisions. Now on question 4 part A, the question reads that MWL Limited has in the past produced just one fairly successful product. However, a new version of this product has recently been launched. In the meantime, development works continue with the aim of adding a related product to the portfolio of products. Given below are some details of the activities carried out during the month of October 2018. We have units produced, existing product 5,000, new product 5,000, production cost shillings, existing product 375,000, new product 70,000. Sales revenue in shillings, existing product 550,000, new product 125,000. Hours worked, existing product 5,000, new product 1250. Development cost in shillings 47,000. Required. Compute the performance indicators that could be used for each of the 4 perspectives in the balanced scorecard. End of question. Now, this is testing on the balanced scorecards, and you know that in the balanced scorecard, there are the perspectives like the customer perspective. We have this is like let's say financial perspective. We have internal, process, and we even have the innovation or growth perspectives. These are the 4 perspectives that you need to address in this question: the customer perspective, the financial perspective, the internal process, and the innovation and growth. Now, of course, for the customer perspective is to show that maybe there is some growth in customers, that customers are happy. So we expect to have some growth here compared to the old and the new product, seeing that there is some growth, or the percentage of the new customers that have come in. So we can be able to look at that. Also, financial is about the profitability. We can talk of profitability, where we may look at the gross profit ratio, the net profit ratio, or any other kind of measure of profitability. Return on something is also very important. Internal process, we may look at the productivity. We want to see whether we are now producing more than before, whether there is that kind of a learning curve or that growth. Are we also producing at a lower cost than before? So the resources we are using, are they now lesser than we were using before per unit? That's what we want to know in the internal process. Then for the innovation and growth is the new products. So this is about, let's say, research and development. Is it bringing us new products? Is it bringing us new ideas? Is it bringing us maybe like new technologies in the production that may also reduce the cost of production? So this is about new ideas and innovation into the production. That's what we want to do. So you're going to use this data and check which one is going to address these facts. If it's about the customer growth, which is going to address financial perspective, which is going to address like that. Now, let's start with the Roman 1. Let's have customer. perspective. Now, looking at the question you have, we do have like the sales. We have existing and you have new products. This is now where the customer comes in. That our sales, our new product is 125,000. That's new product sales. We may want to compare this one with the existing product, and we can even do a percentage, because when you make a comparison, is either a ratio 1:2 or so, but per percentage in this case will be taking the new product divided by total sales in the company. So should we want to say this is new, this is new product. We look at the sale divided by total sales, maybe times 100. That if you take the new product sales, it is actually 125,000. If you divide by total sales of the company, which is 550 plus 125,000 times 100. This is now taking the percentage of the new sales or of the new product on the total sales. So like now you have a total of 550 plus 125. So it is 675. You take 125 divided by the answer times 100. This is giving us like 18.5%. If you were to have the ratio also here, let's say like new product versus is to old product, this is 125,000 is to 550,000. So this is how many times 125 is in the 550. 125. This is 4 points. So you can say it is 1:4.4. So all these are ratios or are measures. These are measures we can use to compare what you are doing with the customer perspective. Now, the existing customers and the new customers, we can measure that way. 1:4, 1:4.4, and this 18.5. That can be enough for the sales. Then we go to the next one. We can talk of the financial. So financial, Roman 2, financial. Perspective. So this one we can use from what we have there. The profit you can get. Actually, we have sales and we have the production cost. Yeah. So those two will give us the profit. So you can say here that profit equals to sales minus production cost. So we can do in total and in existing. So you can start with if you say we start with which one is given there first, existing. So let's say existing. The sales for the existing is 550 and the production costs is actually 375. The sales for new 125 and for the existing the new for the production cost is 70,000. So the gross profit we have here, the profit we have is we can get this difference. We have 550 as a sale minus 375. This is 175,000, and this is 125 minus 70. This is giving us 55,000. So therefore, the gross profit or just net profit ratio. So this is giving the profit divided by the sales times 100. If you want to get that ratio or margin, profit over sales divided by 100. So you have existing equals to 175,000 divided by 550,000 times 100, which will be 175 divided by the 550 times 100 is giving us that 1.8. But the new, it is 55,000, the profit divided by the sales, which is 125,000 times 100. This will be 55 divided by 125 times 100, 44. So you may want to say that the new product has a higher margin than the existing one because it has 44, while the existing has 31.8%. So that is how we can compare about the financial. We do not have any other, because financial is about profitability, and we have one type of cost and you have one type of income, so that is enough. Then we can go to Roman 2. We can try the internal process. Perspective. This one, like I talked about productivity, I can see already we have the units produced and you have the costs. So you can talk of the production cost per unit. Let's talk over this is unit cost. Unit cost equals to total, or we can say production costs. Unit cost should be, we have production cost divided by this is output or units produced. So that we can say now here we have existing. The production cost for the existing is 375,000 divided by the units produced. Units produced existing 25,000. This is going to give us shillings what per unit? Let's see. We have 375 divided by 25. This is shillings 15 per unit. Then the new. The production cost of the new is actually 70,000. The units produced of the new is 5,000. So this is going to give us 70 divided by 5. This is shillings 14. So we can say by now that the new product has a lower cost per unit and even a higher margin. So that is a good thing. So for the financial and the internal, we are doing good because the new has actually a better some better results. Then we can also have here another one apart from this unit cost. We can also have another one here, which is I can see we have the hours. So we can look at the productivity per hour. We can look at the production per hour. This means we take the units produced divided by the hours. We don't know how many units per hour or how many hours per unit. So if we do whichever that comes first. Like if I take my production units to be numerator, I divide by the hours, I'll get to know how many units per 1 hour. If I take my hours to be in the numerator, divided by units, I'll be able to know how many hours I'm using per 1 unit. So you can say here, this is units produced divided by the hours. So like we have existing. The number of units produced, of course, we know they are 25,000. The number of hours that has been used in this existing is 5,000. So this is going to give us 25 divided by 5. This is 5. This is 5 units per hour. Then we have new. The number of units produced is 5,000 units, while the number of hours that we have used is 1250. So this will be 5,000 divided by 1250 hours This is 4. This 4 units per hour. Now this is like saying, should you take the inverse of this? Inverse 5. Inverse is 1/5, which is like a 0.2. This is 0.2 hours per unit. The inverse of this 1/4 is 0.25 hours per unit. What does it mean? It means that the new product is consuming much more hours. It's consuming 0.25 hours per unit. While the existing one, we are doing the 0.2 hours. We are consuming less. So in terms of productivity, in terms of production hours, then you can see that the new product is somehow consuming more hours. But in terms of the costs we are spending on a unit, it's cheaper for the new. Despite it using more hours than the existing, is also going to pay us, or going to incur less cost. And that's why it's even giving us a higher margin. The last one is about the innovation. Roman 4. Innovation or growth or learning. Now this one, perspective. Like I've said there, you look at the whether we are how much are we injecting in the development of the products. So you can say here we have this is a development, divide by the sales, times 100, because this is money divided by money. So what percentage of the sales are we spending on development? Because sometimes we may make out of sales, but they don't do any development. So how much of the sales do we take or do we finance the development of this kind of a product, coming up with a new product or so? So like in our case, because development is in total, we also need to do total sales. So you can see here that where this total sales, to be specific, total sales, this means both the new and the existing, the amount of money we are going to spend here. Sales, we have 550 plus 125,000. This coming to like shillings 675,000. So therefore, the development cost is given as 47,000 divided by the 675,000 times 100. So what percentage are we spending here? We have 47 divided by 675. So times 100. We can say like 7%. We are spending 7% of our sales in creating a new product, in coming up with a new product, and that means we are able to see, we are able to have some new information. So the 7%, it determines, or it depends whether 7% is lower or is higher. But you're not talking about the size. We are looking at how we measure the same. So actually, it's just using this information that you've been given and get to know how much have you spent or received out of an action, which you can be able to measure there. Like now, even though, let's say like the development cost is 47,000, what did we develop? Assuming that we are very categorical, we developed the new product. Then we can say that if we have spent 47,000 and we have developed a new product, which is units, they are 5,000. So assuming that is, but also, although this now will be annually, so divided by 5,000 units, 47 divided by 5,000 units is like saying that and the new product or in the costs, in this cost 14 shillings, if you are to add 9 points, we'll have covered now even development cost. But remember, I have only taken that the cost has been spent for the new product only. So that now, that new product, when it comes to the market, we are sure that if we sell it not higher, not based on 14, but based on like 14 plus 9. That's like roughly 23. If you sell this new product at a price higher than 23 shillings, then actually you'll be saying that you have covered the cost, including what? The development cost. That is how you're able to use it. So I hope that's clear about how to measure the customer perspective, the financial perspective, internal process, and even now the innovation or growth or learning process. That is all about part A. Then part B. The question reads that AZK Limited, a manufacturing company, is planning to launch a new product model whose life cycle is 3 years. For the following estimated cost has been provided. We have details. We have 1st of January 2018, 31st December 2018, 31st of December 2019, and 31st of December 2020. Research and development cost in shillings, 850,400, 200,000 dash respectively. Production costs, variable cost per unit shillings in shillings, dash 100 shillings, 80 and 90 respectively. We have total fixed cost in shillings, dash 500,000, 500,000, 500,000 respectively. Marketing cost, variable cost per unit in shillings is dash 12, 8 and 10 respectively. Total fixed cost in shillings, dash 200,000, 150,000 and 100,000 respectively. Distribution cost, total fixed cost in shillings, dash 120,000, 120,000 and 120,000. Disposal of special equipment in shillings is dash, 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 and you have 300,000. Then you have present value factor is dash, is 1, 0.89, 0.80 and 0.71 respectively. Production units is dash 20,000, 20,000 and 20,000 respectively. The marketing director believes that customers could only pay shillings 120 per unit, but the financial or finance director believes this will not cover all projected cost throughout the product's life cycle required. Roman 1, evaluate the life cycle cost per unit. And Roman 2, comment on the target price by the marketing director and suggest ways of reducing any cost gap. End of question. Now, when we have such a question, the first thing to do, because you can see there is different years, there is the 2018, 2019 and 2020, and you are given the present value factors. You need to discount. We discount to know what is the cost, present value of it at the moment. We compare now with the of 120. Be adding the fixed cost of a particular year and the total variable cost of the same year. That way we'll be able to get total cost. Then we can be able to multiply with the discounting factor so that you can get now the present value of this. So let's see. Let's start from here. We'll be multiplying. I'm going to have the columnar. I'm going to use the columnar format method. At least I'm able to show actually everything that we require in each year. And I want to add the fixed and the variable together. So should we have here, let me call this one as statement of cost. Statement of cost. So you can have here details. I have 1st January 2018, that 1st December 2018, 31st December 2019, and 31st December 2020. So we're going to be adding these costs. So starting with research and development costs. This is a research and development cost. 1st January, remember, it's the current period, so therefore it is already in the present. So this is 850, 400, 850, 400. This one is 200,000, dash, dash. We come to the production cost. We have variable cost. We have 100 shillings, and they have the units there. So if you have 20,000 units at 100, this will give us 2 million. Sorry, this is not year 1. In fact, this year now is closed. This is a beginning. So you have 200 units. 200,000 units, no, 20,000, sorry, 20,000 units. This is going to be multiplied by the variable cost of 100. And this one, to the best of the calculation, will give us some 2 million. Then 2019, we have at 80, and it's 20,000, 20,000 at 80. This shall give us 1.6 million. In that 1st of December 2020, this is times 90. And the units are 20,000 at 90. This 1.8 M. That's about the variable cost. Then we come to fixed cost. Fixed cost. The amount given here is 500,000 here. 500,000. 500,000 and 500,000. Now these are compatible, we can add because they total. But before that, let's go to the next one. We have marketing cost. Marketing cost. We still have variable and the fixed cost. Variable, the units are the same. But remember, if you were given different number of units produced and sold, while in the production would have taken the number of units produced, in the marketing would have taken the number of units sold. But because now our units are the same, produced and sold, we just multiply by the same 20. So this time is times 12. This is 20,000 units times 12. Which is and this one is 200,000, no, 20,000, sorry, times 8. Well, this is 20,000 times 10. So the amount of money we get, this actually will be 240. This will be 240,000. 240,000. This is 160. 160,000. And this is 200,000. That's it. That's it. And then we come to the fixed cost. Fixed cost, 200,000 here, 200,000, 150,000, and you have 100,000, 100,000 there. That's all about the marketing cost. Then the last category is distribution cost. Distribution cost. So we don't have variable, we just have fixed. So you can have your fixed cost. 120,000 here, 120,000, and 120,000. Then we do have disposal of special equipment. Equipment, dash, dash, dash. This is in the final year, 300,000. This is an income, an income. Disposal of special equipment, this can only be an income because in the final year we are disposing that equipment, therefore it can't be a cash inflow. And that's all. So we can add all this in respect of each year. So that now in year 1, as you can see, the beginning of the, this is 850,400 is total cost. This one is 200,000. Then we add to 2 million. We add 500,000 to 40,000, 200,000, and 120,000. This is coming to 3,260,000. The next one is 1.6 million, 500,000, 160,000, 150,000, 120,000. This coming to 2,530,000. The last one is 1.8 million, 500,000, 200,000, 100,000, 120,000, and we'll have minus 300,000. This will give us this is 2,420,000. Yep. This being the total cost, we can now be able to discount using the present value factor. So this is a present value factor. So this is 1. We had the 0 points. So 1, 0.89, 0.80, 0.71. That now when you multiply, we'll be able to get the total. Total per unit, and total first of all, we'll get per unit later. So this is actually 850,400. The second one, you multiply, that's 260. That's 260,000 multiplied by 0.89. This is a 2,901,400. Then this one is 25,30,000 times 0.8. This is 24,000. And the last one is 24,20,000 divided by times 0.71. This is giving us 17,18,200. This is what we call the present value. So present value. Now this is present value of each and every year. So that now we can say ultimately we can add all these and we get to know the total. So you can see that therefore total present value we need to add. And as we add all these, we'll have them as plus this 17,18,200 plus 24,000 plus 29,01,400 plus 850,400. This coming to shillings 74,94,000. Total present value of the whole of this work within the 3 years shall be 7,494,000. So looking at what we were asked, this is in fact this is total life cycle cost. Now total life cycle cost is this much. So we can divide by the number of units. So within how many years? These 3 years, the total units are 60,000. You can see that life cycle cost per unit will be 94,000 divided by 20,000 units times 3 years. This is going to give us what? So remember, I've added the 3 years. And why we could not have added literally this cost 850 plus 32 is because these costs are not in the same year. That is not the same year. We have to discount that. You can have them harmonized. So when we add, I got now that 94,000, which now if I divide by 60,000, which is the total production within the 3 years, then I'll be able to get, I divide this one by 60,000, I'm able to get shillings 124.9. So this approximately is like shillings 125 per unit. So that now we're able to answer Roman 1. Evaluate the life cycle cost per unit. We have done that. Then Roman 2. Comment on the target price by the marketing director and suggest ways of reducing any cost gap. Now for us to get the cost gap, we are going to say here that this is now Roman 2. So we can say cost gap equals to, we normally say you take the estimated and the target cost. But in our case here, looking at the price given there, the marketing director believes that customers could only pay shillings 120 per unit. So if that's the target price, if you compare with our target cost or either the estimated cost, this what we call the cost gap. First of all, let me just say cost gap will be the estimated cost minus target cost. The only thing we have is that we don't have the profit margin or markup, because we're supposed to, in this 120, we're supposed to subtract the target. Like now if you say here, where target cost equals to target price minus profit margin. In our case, we don't have the profit margin. So we are supposed to take the target price of 120, we subtract the profit margin, we get the target cost. Then now that target cost we compare with the estimated cost. So this effect as something missing, that if we had it, they automatically would have gotten the correct cost gap. All in all, therefore, estimated cost is roughly 125, then less target cost. So we can say or price here is 120. So we can say here this is a minimum cost gap is 5. Why did I say minimum? Because we have not even subtracted what? The profit in the 120. We are not supposed to subtract the margin. If the margin, assume the margin is 10 shillings, then this should have been 110. 110, if you subtract one from 125, this should have been 15. So I'm saying that 5 bob or 5 shillings is the minimum cost gap. So the cost gap will be higher than 5 shillings as long as we intend to make what? A profit. That's the position. Now the question is, how do we reduce this cost gap? Now, because this has been done before, has been done way before we engage ourselves in the production, what we need to do is that if there is any cost cutting, it can be done before we commit ourselves to this production. The cost cutting concerning the specific cost, like the research and development cost, the production cost, the marketing cost, and the distribution cost. Those are costs that we are supposed to do some cost cutting evaluation, see where we can be able to reduce the cost. By so doing, this cost will be reduced to maybe like 110 or below. If the production can increase while the cost is constant, especially for the fixed cost, we don't expect the cost to vary with the production. If we can increase the production from 20 to like 30 per year, so that now at least we can divide by 90, assuming. Instead of divided by 60, divided by like 90 or more than 60, this figure will be reduced, will be less than 125. So we can increase the production without necessarily increasing the cost, and you can take advantage of the fixed cost. Adding the fixed cost, all of them, like now this one is 1.5 million, and we have also these other ones here, that when you add them, suppose you're able to get like say 2 point something million, we discount, you say 2 million. If the 2 million, we can increase the production and the 2 million is constant. Like here, let's say you have 2 million fixed cost and the production increases. You see now it does not require cost to increase. So therefore we'll be having some reduction in the cost. At the same time, if in the present value factor, you know this is a discounted factor, the discounting rate that was used, assuming that we used like 10% discounting rate, if it is high, it does not reflect the economy or the inflation rate, then of course you need to adjust that rate, because sometimes if you use a wrong rate that does not factor in the economy, then of course we'll be having a wrong factor to multiply. So therefore we need to also do something there. We can also do some training of our employees so that at least they can be able to increase the productivity, that they can produce more than we are producing. We can incur less cost of production, like the variable cost per unit is 100, 180 and 90. Maybe here there's something that we have not done. We can try to train them, and then we can incur less per unit. About the marketing, it's not that as bad, only that in year 3 there's a problem. Marketing a unit is 10 shillings while it was 8 shillings in the year 2019. So we can do something so that we can incur less cost. We can even engage our customers and they come for the product. Instead of us moving the product to their places, they can come for the product. That way we can reduce our marketing cost and especially the distribution cost. So that is also another way. So to some extent, those factors, should you actually look at them and see how we can evaluate each, how we can minimize the cost for each, ultimately be able to balance and clear this cost gap. Material, production cost include material, labor, all those individual costs. Should you be able to reduce their usage, you're able to actually factor or get the benefit from this. And that's all about this question 4. So we are going to meet in the final question 5, in the next lesson. For now, that's all, and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.